What's up, guys? Welcome back to DCA. So today I'm going to take a look at another one of these metrics which can help us analyze where the market's at in order to potentially understand how much further downside could there be in this market. Now you have to keep in mind that anytime we're looking at an indicator or talking about one of these metrics, discussing these indicators and trying to identify where a potential market cycle bottom could occur, you have to keep in mind that to a certain degree, this is going to be contextual. And when I say to a certain degree, I mean to a large degree, it's going to be contextual. And what I mean by that is the fact that we simply can't escape the overriding macroeconomic picture. Now, does that mean that this type of market analysis or looking at metrics, trying to understand where the market is at, is a futile endeavor? And I don't think that it is. If I believed that this was a waste of time, I wouldn't be making these videos. I wouldn't waste my time talking about the crypto market. So what I'm getting at is I do believe that there is an element of utility to be gained from analyzing the state of the market at any given time. Understanding where we're at now in relation to historical frames of reference, and then using that information to actively adjust our investment approach or to, at minimum, inform ourselves when a potential market shift does occur. We'll be analyzing how this affects each market cycle and how it's affected every single cycle so far. So we're talking about the 2014 cycle, we're talking about the 2017 into the 2018 cycle, and now how it's playing out in a very similar manner right now in the 2021-2022 market cycle. So we're going to take a look at this, we're going to dive in, and in this video we're going to talk a lot about investment philosophy, the mind frame that particular groups of investors have. And the reason I say that is because this metric illustrates that perfectly for us. So we're going to look at this, and then hopefully not only will you learn something about the crypto market, about where we're at right now, about potentially where the market cycle bottom may be, but also how to improve yourself as an investor, how to improve your mindset as a long-term or perhaps a short-term investor. And I think that the data that we'll be looking at today is very helpful in that regard. So with that said, guys, let's do it. So the first thing I want to do today is show you the metric. We'll look at it, we'll see where we're at as a baseline at the moment, and then we'll talk about why this metric is important, and in my opinion is ultimately going to be a rather strong indication of just how much additional downside pressure there could be in these markets. Now, there's obviously other tools that we've looked at in recent videos, which we've looked at in order to attempt to understand where the market is at right now in relation to where it could potentially go. And there's one common theme that all of these metrics share that I think is relevant to the analysis that we're doing. Typical behavior of the underlying core groups of individuals who hold Bitcoin and the way in which they interact and react to the price fluctuations of Bitcoin on both the long and short-term timescales. These behaviors tend to repeat over and over and over again. And we've seen this play out numerous times now. So in recent videos, we've demonstrated the fact objectively that the majority of the sell pressure over the last 8 months, and perhaps more importantly over the last 3 to 4 months, has come from two groups primarily. And these are holders of Bitcoin who bought the asset during the peak phases of the cycle. So we're talking here in January through May of 2021, this period right here where the price was 40,000 all the way up to 64K. And then a second period in time from right here when we started that second phase of the rally where we went from around 34K up to around 69K. And then realistically, even into December and January. And finally, at that point where we hit around 48,000 in March. So we mentioned that group in particular because we've seen a lot of selling coming from those individuals during this market crash. During this time here in March, when we got to around 48,000 here on March 28th, since that time, we've absolutely plummeted. We've come down to where we're at right now at around 22K. We're down around 54%. So we've seen a lot of people that by definition qualify as long-term holders because remember, These investors who own Bitcoin for more than 6 months, these guys are significantly less likely to sell over time. And there are numerous studies on this particular topic demonstrating that that is objectively true. However, what we do typically see is that these individuals who buy Bitcoin in bull markets during the actual parabolic phase of the cycle, they tend to get caught at the top, and these guys become very prone to capitulation when we start to see the massive market contractions that we see during every bull market. So the unfortunate reality of this cycle is we spent too much time near the top. And that's problematic because it gives these newer investors all this time to be acquiring the asset at these elevated prices, and they're able to acquire this prior to the true major market crash right here on March 28th, when we started that trend down from 48K. So what we're saying here is, by definition, we know that long-term holders tend to hold the asset more. However, what's unique about this cycle is that a lot of these newer investors have came in and they've bought at these extremely elevated prices, and they are technically labeled as long-term holders. However, we've seen empirically that these guys are prone to making a lot of the same mistakes that you might see from shorter term holders. Once the price has started to crash from here at around 48K in March down to 30K in May and into June, these guys, a lot of them bought into the belief that was popularly spread on social media. We're talking YouTube, Reddit, Twitter, which is the price is never going to go below 30K again. And not only did it go below that level, it did so in spectacular fashion as we went all the way down to around 17.5 right here after the Luna UST event in June. So we've shown in numerous videos where that panic was coming from. It was coming from shorter term holders and individuals labeled as long-term holders who are individuals that bought above that 40K level, although they technically qualify as long-term holders. So the point that I want to get across specifically today is the fact that I think there's still a lot of macroeconomic uncertainty looming over us. And at this point, I think it's almost to the point where we're becoming a broken record about this fact. But it's that important. It's that important to understand. And we've been saying this on the channel going all the way back to December. We've been talking about inflation. We've been talking about the Fed. We've been talking about issues related to COVID. We've been talking about the Fed funds rate. And we're talking about these things because they're going to have an influence on the market, on this market cycle in particular. And that's because of the fact that at the end of the day, as institutions become more involved in the cryptocurrency market, you know, the market isn't like it was back in 2014 or even 2017 for that matter. The market cap of the cryptocurrency asset class is massive, where we're nearly at $1 trillion now. And at our all-time high, we were over $3 trillion. So retail simply doesn't have that type of money to make the market go parabolic when you're sitting at those kinds of valuations. You have to have institutions coming in and investing in the asset class if you want to see the price continue to go up higher, especially when we're talking about valuations of approaching $3 trillion. And so you have to keep in mind that these institutions are operating under particular constraints that the average retail investor may not necessarily have to abide by. They are considering things like when the interest rates are rising, for instance, when inflation is rising, when we're seeing global energy and food shortages to a degree. There's a conflict which has the potential to snowball and could draw in a lot of the world's largest nations. When you have these situations playing out right before you, these institutions are naturally going to take a more conservative approach, and they're going to shy away from risk assets. And Bitcoin, regardless of what people like to label it as, Bitcoin is the premier risk asset. So when that's happening, you have to imagine that it's going to be difficult for us to see the market just go on some sort of wild run from here. And given all of the uncertainty, by definition, it's why we call it uncertainty, you have to approach the markets with the understanding that there's a lot of downside potential remaining in the market period. And that's because I'm not telling you that definitively we're going to the downside. I'm telling you You have to approach the market right now with a healthy appreciation of what the potential is. So we could very well see one of these scenarios play out right now where the markets consolidate for an extended period of time, like we saw back in 2015, right? Like we saw right here in 2015. We saw the markets go from January to October where we traded in an extended consolidation range. We were up some, we were down some. The price just sort of oscillated in a fairly narrow gap for that time at least. So I'm just making the point, reiterating that point yet again, because I just want people to understand that just because we see this small price move right here where we've went up to around 20K, 22K, and for that matter, even if we went up to 40K, which we're prone to see those types of moves in the crypto market, where we have these big moves to the upside that look positive and then just result in a massive reversal. And oftentimes when we see these price moves, when the market has an overriding bearish bias, we often see the price get rejected, and it gets rejected hard. It's just to relate to you that you should demonstrate a fair dose of caution when you're investing in this market, or at least have an appreciation for what you're potentially looking at going forward. So that pretty much sums up the first group that we're talking about today and brings us to the second group that we're talking about. And these are the short-term holders. These are the guys who have the asset for less than 6 months. And statistically speaking, they are significantly more likely to sell into any type of significant price move, be it up or down. So essentially, we're saying that they are highly sensitive to price, whereas our long-term holders can be summarized or thought of as being price insensitive. And what we tend to see is the longer that they've held, they are less sensitive to price. So these guys who have been holding for years and years, statistically speaking, going forward on any given day, they're going to be less likely to sell than someone, for instance, who's been sitting on a massive loss up at 50 or 60K for just a year or two. You know, we're talking about the guy who's been holding maybe since November of 2018 or earlier, sometime in 2016. That guy has proven time and time again that he is price insensitive. Okay, guys, so that was a long-winded segue to bring us to the chart that we're going to look at today, and that's this chart right here. So we're going to look at this in two different ways, and the first way that we're going to look at it is the long-term holder to short-term holder percent in loss. So what we have here in the aqua color is the percentage of short-term holders that are holding coins at a loss, and then conversely, in pink, the percentage of long-term holders who are holding coins at a loss. So we're looking at data here from back in 2016, and recall that just prior to that, we were coming out of that extended bear market where we had went down from around $1,200 at our all-time high all the way down to around $150 or $160 in 2014. So basically all of 2014 was a bear market, nothing but downward pressure. And 2015 was basically nothing but a sideways consolidation. And then finally in 2016, we were starting to move up. So you can see here that throughout 2016, we basically saw the percentage of holders, long-term holders, who were sitting at a loss was rapidly decreasing. And we were decreasing all through the beginning of 2016, and the percentage of long-term holders sitting at a loss at that point, at its peak, was around 21 or 22%. That rapidly dropped as we came into May of 2016, and it rapidly dropped all the way down to around 5 or 6%. And then we came into 2017. Notice that the long-term holders of the asset, these are going to be the guys who've been holding for 6 months or more. They were unanimously sitting at a profit right in this region here. And what we see during this time, during the bull run, anyone who's a long-term holder was rewarded for their patience. This is what I want to talk about today. Notice that as we're coming into the bear market of 2018, right around here, so the price has kind of topped out for Bitcoin, and we're moving into 2018. And notice that the long-term holders of the asset, the amount of long-term holders that are sitting at a loss as we're moving towards 2019, that big price crash that we had in November of 2018, where we went down to around $4,000 and then ultimately wound up at around $3,400 in December of 2018 and early 2019. The long-term holders sitting at a loss absolutely spiked at this level. So it went up all the way to around 35%. What we actually see is that at these points of peak capitulation, like we see here in 2019, even like we saw back here at the beginning of 2016, because remember, we were coming off of a long consolidation period. At these points, we see that the long-term holders that are sitting in a loss actually becomes higher than the short-term holders that are sitting at a loss. So who are these people then? And these people then are going to be all investors who bought during these stages of the market that we're constantly warning people not to buy into. So they are guys who are buying into Bitcoin during this time period. So they are going to be guys who are buying into the bull market, doing the opposite of what we typically say on this channel, makes a wise investor. And we've seen that same thing in this cycle. We've had a huge number of people who have bought up in this range. The amount of time, like we said, we've spent nearly a year in this range where people could buy at these extravagant prices, at these price premiums. And back in this cycle, back in this 2017, 2018 cycle, we didn't spend nearly as much time within that percentage range of the all-time high. So this has just been an exceptionally unique market cycle because we've spent so much time up at the all-time high. We've given these newer investors so much time to buy. Okay, so this is the long-term holder to short-term holder percent in loss gradient. And what that means is we're simply looking at the long-term holders in loss subtracted from the short-term holders in loss. And so if there are more long-term holders at a loss than there are short-term holders in terms of percentages, this will be in this pink color here. So these times up here that are in pink, these are times when the long-term holders percentage-wise have exceeded the short-term holders in terms of holding at a loss. And so these are exceptional times in the network. The first time we see it is right here in 2016, like we said. We see it again in late 2018 and during the COVID capitulation event. And now yet again, you're seeing that we have come to a place in the cycle where the long-term holders sitting on a loss have actually exceeded the short-term holders at a loss in terms of percentage. Now, one other thing we can do, which is interesting, is correlate these findings to this chart. This is showing us the amount of coins held in loss in the total supply in terms of a percentage of just the total supply by long-term holders and short-term holders. And we can break this down by market cycle. And what we can see is that back in the 2015 cycle, that the amount of coins held by long-term holders that were in loss was down to 35%. And when we look at short-term holders, they actually got all the way down to around 3.2% of the supply. So the vast majority of the coins held in loss were by long-term holders. 91.6% of that total number of coins held in loss. And then you can see that in this cycle in 2018, it was very similar. The long-term holders in loss was all the way down to 34.2%, whereas the short-term holders in loss was down to around 4 to 5%. So the dominance of the coins being held by long-term holders was around 90%, very similar to the 2015 cycle. Now, if you look at this cycle, this sort of indicates that there may still be some room to go in this cycle, because let's look here. The long-term holders right now make up around 28.5% of the coins in loss, whereas the short-term holders are holding around 16.2%. So that means we haven't necessarily reached that peak level of capitulation that we've seen in these prior cycles. Now, that doesn't mean that has to happen in this cycle, but it's certainly something worth considering, that we have seen in prior cycles a much larger overall washout from the short-term holders. We haven't necessarily seen that in this cycle. And so it could be suggested that we need more time in the bear market. We need more of these short-term holders to kind of lose their nerve, or not even necessarily lose their nerve, but just get bored of an asset that's doing nothing but trending down. So the whole reason that this analysis even matters in the first place is because of the fact that once you've had that maximum shakeout of anyone who's willing to sell the asset, that's the point when the price can start to consolidate and or start to move up, because then you're in one of those time periods where there's an overreaching market uncertainty, periods where the price goes up 10, 20, or 30% and gets rejected off of one of these key price levels. Because of the fact that you still have these price-sensitive investors in the market, it's not until you're able to shake these guys out, the last of these individuals, like we saw back in 2019, like we saw at the COVID capitulation event, so both of these events here, and like we're starting to see now. It's not until those times when those guys are completely shaken out of the market, when your long-term holders are sitting at a loss in aggregate, and they're significantly more long-term holders at a loss than there are short-term holders. It's not until those times that the price can truly reset. And so we're starting to make progress in that arena right now. However, I think based on everything we're seeing, it's going to continue to take more time. I don't think we're quite ready yet, and I don't think the market is quite ready yet to truly make this upside move. So we're moving towards a place where we're shaking out a lot of these guys. But at the end of the day, there's still room to go. I think we went over a lot of concepts and a lot of topics and a lot of things related to market psychology, investor psychology, and quite frankly, I think a lot of philosophy in terms of the thought process of a more successful investor in relation to a newer, likely to be less successful investor. And that's to be expected because the newer investors, anytime we're new at anything, we're very likely to be less adept at it. And we're going to make mistakes. So I think ultimately the takeaway here is when we're thinking about the price and these downside moves, even these extreme downside moves, it's good to keep in mind and to reflect historically on how the more successful investors in the asset class, or any asset class for that matter, how have they reacted to these price moves? And how have the less successful shorter term investors reacted to these price moves? And time again, we see that the long-term investors are looking at the asset not in relation to what it's going to do over the next 6 to 12 months, or even 12 months to 2 years, but they're looking down the road 3 or 4 years, or perhaps even longer than that. And they're making a plan at this point in time that they intend to carry out. When you do that, when you start to have a thought process like that, you're putting yourself on a track for financial success. Because we've seen repeatedly throughout history, these strong assets that have a lot of upside potential, these are the types of assets that can change your financial trajectory if you have the appropriate time horizon. We see it time and time again. And it doesn't matter if it's the stock market, look at the 2000s into the early 2000s, look at 2008, 2009. If you look at that opportunity to buy that was provided during those times in the market, your downstream reward was massive. However, if you're someone who's chasing the market in 1998, 1999, you got annihilated over the next 2 or 3 years. And quite frankly, you weren't profitable again, or the market in general wasn't profitable again for almost 15 years later. It wasn't until around 2013 that, the NASDAQ, for instance, got back to that all-time high that it reached in 2000, or got above it anyway. But if you were buying it at discount prices, if you were looking for strong assets to purchase at discounts, assets that had strong fundamentals, assets that had a strong track record like Bitcoin does, if you were looking for discounts and buying during those times, you were handsomely rewarded, and that has panned out over and over and over again. So that's going to be it for this one, guys. I know this was a long one. I know we talked about a lot, and I think this video was important in order to discuss the philosophy of an investor, of a successful investor, as much as it was to analyze the data. Because in this particular case, with this video we looked at today, those topics go hand in hand. So that's going to be it for this one, guys. Until next time, as usual, see you.